Diversification reduces the risk, right? And I will diversify my portfolio. So, should I invest in more than 10 mutual funds for more diversification? Hey guys, welcome to Financecator, the place where we spread financial yarn. If you are investing in mutual fund, it's always important to create a diversified mutual fund portfolio. You might have heard this statement from many investors. It's equally important to have a thorough understanding about it. So, let's have a discussion on it, and this will definitely help you to take appropriate decision. Now, what is mutual fund? It is an investment tool that enables an investor to invest his or her money in different securities like stocks, bonds, money market instruments, and other assets. If you want to know about mutual fund, then you can see the link in I button. Let's begin with the basics. You all already know about diversification, but I would like to present in my own words. Diversification plays major role in investment. Moreover, it's all about adding variety to your investment portfolio or investing in diversified investment tools to bring down the investment risk. There are many investment options. You can allocate your money into different types of investments such as gold, stock, mutual fund, bonds, insurance, real estate, and other asset classes, and expect to get a balanced return in the future. For example, if you are investing all your savings in gold and gold price drops in the near future, your investment will suffer loss. But if you have invested some amount of your savings in stock market along with gold, you would have minimized the overall risk because we know that gold price drops and stock market will increase. Hence, allocating your savings in diversified investment tools helps providing you a safety net. This is why diversification is important. Similar to the above discussion, to create a diversified mutual fund portfolio, first thing you need to do is to choose your fund carefully and invest in different types of funds that have holdings in diverse stocks and securities. There are multiple options in mutual fund for investors like equity mutual fund, debt mutual fund, and gold funds. And all of these fund categories have their own risk level. Equity considered to be riskier and debt which is less riskier. And all the fund categories are divided into subcategories. To be more precise, when it comes to equity mutual fund, there are large cap funds which are less riskier than small and mid cap funds. The next is debt fund which is less riskier, but in that there are corporate bonds that might be riskier than those with more exposure to government securities. This is the time to understand the strategy of diversification. The first and foremost thing you should know is how much loss you can tolerate. That is risk appetite. If you know your risk appetite, then for sure you will be able to diversify. For example, a person X is investing 5,000 every month for 15 years. For this, he invested in large cap mutual fund. Keeping in mind his risk appetite, he decided to invest in small cap mutual fund. Since small cap mutual funds can give good returns than large cap mutual funds. Is this a good strategy? What do you think? Mr. X did not see anything wrong with his investment because this decision will help him to achieve his target return which he expects after 15 years. Let me elaborate this. According to Mr. X, large cap investment offers him around 10 to 12% return. On the other hand, small cap investment can offer him around 15% return. And by diversifying, he can achieve his expected return from the investment after 15 years. This is the main reason why most of the advisors and investors suggest everyone to choose investment that match your risk profile and investment objective. The second step is building portfolio. Like discussed above, you should know your risk appetite, then invest in mutual fund. Then, investor must build a portfolio that includes various instruments like stocks, bonds, mutual funds, golds, or even cash. The, the third is to research about the fund manager. To achieve good returns, it is equally important to know the skills of fund manager because fund manager is the person who makes the decision of when and where to invest. Now, you all might have good idea about what diversification is and how to diversify. On the other hand, it is equally important to know and have knowledge about over diversification. Do you know what makes a mutual fund portfolio over diversified? If your answer is no, then next few minutes is very important for you. An over diversified portfolio means having too many funds of different categories and asset classes. The most important thing to remember is that over diversification may not make you lose money, but it doesn't help you to gain any better. In fact, in many cases, an over diversified portfolio leads to higher expenses and added burden of maintaining, managing, and monitoring them over time. A small diversified, managed, and analyzed mutual fund portfolio can fetch you good returns than a large, over diversified, mismanaged one. Have a look at this example. If a person invests in 500 different fund houses, definitely he would reduce the unsystematic risk. But the problem comes in reviewing those 500 funds. This person will have to research about all 500 funds. Using the same example, let's understand what proper diversification is. Instead of owning 500 funds, if the person would own only 30 best stocks, that will reduce the burden of managing and analyzing. However, there is no specific number for proper diversification. That would only depend upon how much stocks you can review, manage, and analyze. If you can review only 10 funds, that's fine. Select best top funds and invest. First thing you should know is investing in mutual funds through SIP route is an excellent investment option. SIPs allow you the flexibility to invest a small amount on a regular basis. The best way of reaching rupees 1 crore by investing is first one is investing 30,000 rupees a month in an equity oriented fund that would fetch you 1.01 crore if the fund provides 15% every year for 11 years. If you can spare 15 to 16,000 rupees every month, like if you can invest 16,000 every month and your mutual fund offers an annual return of 15%, you would be able to create a corpus of rupees 1 crore in 15 years.